Today we're going to go through the beginner's guide to mortgages. We're going to walk through all the jargon and all the tips starting from the right beginning and teach you everything you need to know about home loans, buying a house, an investment property, and more importantly, getting a mortgage. Let's jump right in. All right, so let's start from the very beginning on what a mortgage is. A mortgage is effectively a secured loan that a bank will give you to buy a property. Now, the good thing is with a mortgage is that the rates are generally lower than compared to say a car loan or a personal loan, which is considered an unsecured loan, meaning that if you go get a car loan from a bank, they generally won't hold the car as security.
We don't do that here.
So if something goes wrong, they've got less recourse and they generally charge a higher fee. So in general, a car loan in Australia might be 8, 9, 10%, depending what you get. Whereas a home loan in Australia, which is secured by a property, is in the 3 and 4% range at the moment. So in other words, if you have a mortgage, the bank holds it as security, and if something were to go wrong, they'd obviously pursue you for the money, but then the bank could sell the house and recover some of their loan that they gave you. Let's have a look at how that might work. So as you can see from the example here, if you're buying a home for $500,000, you might have a deposit of say $50,000. The bank would put a loan or a mortgage of $450,000 against that property. So you'd need to come up with some sort of deposit. In this case, it would be say $50,000 or 10% of the purchase price. Now the banks in Australia will not do a no deposit home loan just on a standalone property like this. You'd need to get the help of a guarantor, or you need to have some hurt money or deposit to be able to buy a home. A common term you might have heard of is LVR, or loan to value ratio. So loan to value ratio is the loan amount divided by the home value to equal a percentage. In this case, it's 90%. So in other words, it means that you're putting in a 10% deposit to buy the home. In Australia, at the moment, generally speaking, you need a minimum of 5 to 8% deposit to buy a house. So if you were getting the first homeowners grant, for example, on a $500,000 purchase, you might be able to get away with as little as $25,000 in deposit, but you still need some money, which can be gifted. And like I said, there's other things you can look at there. If you have less than a 20% deposit and you're wanting to get a mortgage in Australia, it is possible. There is an insurance that the banks get called lender's mortgage insurance. Now this is an insurance to protect the bank because you have less deposit. So in the bank's eyes, you're slightly higher risk, because if they sell the property and as per the last example, if they have to sell the property, they owe $450,000 or you owe $450,000 on the property, they only have a little bit of leeway there. But if there's a 20% deposit, obviously it gives them more comfort.
Everybody comfortable?
Yeah.
So lender's mortgage insurance is an insurance to protect the bank, and it's there if you have less than a 20% deposit. Now it's based on a sliding scale. So the amount that the lender's mortgage insurance will be will vary depending on the purchase price, on how much deposit you have, even the property type. But just be aware that it's there, and unfortunately it's one of those opportunity costs that you need to pay if you're looking at buying a home. Another aspect to be aware of if you're looking at applying for a mortgage in Australia is your credit score. Now the banks will do a credit inquiry on you before you apply for a home loan or a mortgage. As you can see on the screen, your credit score will vary on lots of factors, including your credit history, so how many credit cards or personal loans you've applied for in the past, if you've had any missed payments, and lots of other factors. Generally speaking, a credit score of 700 or above will make you eligible for a home loan. You don't need to worry. If it's below that, then probably chat to a mortgage broker and see what your options are.
See, not winging it isn't really what they do.
Now, a few things to be aware of a mortgage compared to other loan types. Number one, a mortgage generally has a longer loan term. So if you're buying a car, for example, your loan term might be anywhere between 5 to 7 years. But if you're buying a house with a mortgage, the loan term generally by default in Australia is between 25 to 30 years. Secondly, as I already mentioned, the mortgage is secured against the property that you purchase. So if you don't keep up with your loan repayments or you fall behind, then the bank, or the mortgagor as they're known, has the right to sell the property and kick you out of there. So you want to make sure you keep up with your loan repayments.
What do you mean it's coming, Denny? Where's my money?
Okay, just give me 5 minutes.
And number 3, another basic of mortgages in Australia is that you cannot borrow the full purchase price. As I mentioned, that's only if you're buying the property standalone and you don't have the help of a guarantor. So generally speaking, in Australia, you're gonna need at least a 5% deposit to buy a home. The banks wanna see a bit of hurt money there to make sure that you're gonna not just walk away and run away from the keys like kind of what happened in the GFC in America.
The market's in an itsy bitsy little gully right now.
That's it for today, guys. If you have any questions, make sure you hit us up below or check out some of our other videos which go through some of the advanced techniques of getting a home, negotiating, and paying off that loan much quicker. If you've got any questions, hit us up at huntergalloway.com.au. Thanks.